Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Resources Building Materials Technology Holdings Limited Annual Report. China Resources Building Materials Technology Holdings Limited is a diversified investment holding company that operates through various segments to provide a wide range of products and services. The company's main business includes the manufacture and sale of cement, concrete, aggregates, engineered stones, natural stones, and other related products. In addition to its core businesses, the company also engages in excavation, production, and distribution of clinker products, as well as prefabricated construction materials. It is involved in environmental protection engineering activities, mining of aggregates, trading of construction materials and steel pipes, property holding, marine transportation, warehouse management, fuel supply, and provision of building materials testing and consultancy services. The company's products are used in various infrastructure projects such as railways, highways, subways, bridges, airports, ports, dams, hydroelectric and nuclear power stations. Its products also cater to the construction of high-rise buildings, suburban and rural area development. With a history dating back to 1998, China Resources Building Materials Technology Holdings Limited is a subsidiary of CRH Cement Limited and has its headquarters in Wan Chai, Hong Kong. China Resources Building Materials Technology Holdings Limited maintains a market capitalization of $11 billion, broadly in line with the industry peer group. China Resources Building Materials Technology Holdings Limited trades at a higher price-to-earnings ratio of 27 times and a lower price-to-book ratio of 0.26 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be attributed to several key factors. On the positive side, the cement segment has seen a significant increase of 4.5%, page 7. Additionally, the expansion of aggregates production capacity is expected to reach 125.9 million tons upon completion, contributing to revenue growth. Furthermore, self-operated foreign trade sales volume has increased by approximately 30% year-on-year, page 21. On the other hand, certain segments have experienced a decline in revenue. The concrete segment has seen a decrease of 7.3%, page 7, while the aggregate segment has declined by 17.1%, page 7. Moreover, there has been a significant drop in floor space of new commodity housing sold, minus 8.7% year-on-year, and sales amount minus 12.6% year-on-year, to RM 8.4 trillion, page 13. The real estate development investment has also seen a decline of minus 17.2% year-on-year, to RM 8.3 trillion, page 13. These factors highlight the importance of monitoring key performance indicators in various segments to understand the drivers of revenue growth or decline. By analyzing these metrics, companies can identify areas for improvement and make informed decisions to mitigate losses and capitalize on opportunities for growth. The company's financial performance has undergone a slight decline in recent times. A notable drop of 7.3% was observed in net income, which decreased from RMB 3,800.3 million to RMB 3,521.4 million. This decrease is reflected in the operating profit margin and net profit margin, which are implied to have also declined. Despite this decline in net income, the company's gross margin has shown a slight improvement, increasing by 0.2 percentage points from 16.5% to 16.7%. However, this marginal increase was not enough to offset the decrease in net income, resulting in an overall decline in profit margins. The reasons behind these changes are not explicitly stated, but it is clear that the company's financial performance has been impacted by various factors. The company's debt level has undergone a significant change over the past year. Initially, bank loans decreased by RMB 3,618,207, 24.6%, indicating a reduction in short-term borrowing. However, this decrease was followed by an overall increase in debt levels compared to the previous year. This mixed trend suggests that while the company reduced its reliance on bank loans, it may have taken on more debt from other sources. Regarding interest expenses, there is no explicit mention of a change in the level of interest payments. Nevertheless, the coupon rates for medium-term notes issued in 2024 and 2025 are relatively low at 2.44% and 2.12%, respectively. This could indicate that the company's interest expenses may remain stable or even decrease due to these lower borrowing costs. The performance of various segments and regions has been analyzed based on the extracted summaries. In terms of segments, cement and concrete have shown poor performance in both 2024 and 2025. On the other hand, aggregates have performed well in these 2 years. In terms of regions, China stands out as a notable performer, achieving good results in both 2024 and 2025. This suggests that China has been a strong market for these industries. Overall, while some segments have struggled, others have shown resilience, and certain regions have emerged as key drivers of growth. The company's outlook is optimistic due to steady growth and increasing domestic demand. Management has outlined key strategies to drive future success, focusing on core product categories and key markets. This approach will enable the company to upgrade its channels, products, and management, ultimately bolstering its foundation for long-term development in the functional building materials business. Management is also prioritizing risk prevention and operational control to mitigate potential challenges. By concentrating on these strategic initiatives, the company aims to capitalize on emerging opportunities and maintain a strong market position. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would impact its overall operations and financials. This lack of activity suggests a stable and focused approach to business management, with the company choosing to maintain its current structure and resources. The company's financial performance is a crucial aspect of its overall health and stability. A key indicator of this is the payment of dividends to shareholders. According to the provided information, it is clear that the company has indeed paid dividends. This decision to pay dividends suggests that the company is generating sufficient profits to distribute some of them back to its investors. The proposed final dividend per share mentioned on page 1 further emphasizes this point. Additionally, the confirmation on page 10 that dividends paid, yes, leaves no doubt about the company's commitment to rewarding its shareholders. The payment of dividends can have a positive impact on shareholder confidence and loyalty, as it demonstrates the company's ability to generate returns on investment. It also provides an opportunity for investors to benefit from their stake in the company. Overall, the decision to pay dividends is a significant aspect of the company's financial strategy and a testament to its stability and profitability. There are concerns about inventory buildup in the company's operations. The data suggests that there have been significant write-downs of inventory in recent years, with RMB 46,044 written off in 2025 and RMB 65,699 in 2024. This indicates a potential issue with managing inventory levels, which could be due to overstocking or other factors. The buildup of inventory can have significant financial implications for the company, including lost revenue and increased costs associated with storing and maintaining excess stock. Furthermore, it may also indicate inefficiencies in the supply chain management process, which could lead to further disruptions if not addressed promptly. That concludes the financial summary for China Resources Building Materials Technology Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.